Hey guys, this is Phil Nelson, and you are listening to my brand new podcast, Capital Creation Project, a show that talks about the up and down journey to find financial freedom through entrepreneurship. I decided a long time ago that I was going to choose the life of risk in hopes of gaining the reward, and it has been a journey of both good and bad. I'm nowhere near the end goal, but I've learned that this is all a part of the ride. Hey guys, welcome back to the next edition of the Capital Creation Project. I'm your host, Phil Nelson, and today's a special show for me. Super excited to introduce you guys to a good buddy of mine, family friend, Pierce Rankin over at Fairway Mortgage.
Thanks for having me on, Phil.
Yeah, absolutely. Like I mentioned, he is family friend, we've been friends for probably the last decade or so now. The story goes that our wives are actually the reason why we are sitting in these seats today.
That's correct.
Right.
That's
so
correct.
I guess we owe it all to them.
We do. We won't tell them.
Right. All the income goes to them anyway. So it's really, I think
good point. Very good point.
They're compensated for this at this point. Former professional athlete, dad of 3, University of Washington alumni, which means he has been insufferable on the group thread as he is rubbing it in my face of being a 2-time CFP.
Rightfully so.
Entrant. So go Dogs, as painful as that is
Dogs.
for me. Manages the Fairway office in Kirkland. So we'll be a wealth of information here today as we talk about capital markets and kind of what's going on here and as we start 2024. So super excited. We've been in a bit of a roller coaster. Interest rates up, interest rates coming down a little bit. But really since what? The GFC, we haven't seen interest rates this high.
Yeah, 2005-ish.
Oh, wow. So even before.
Yeah, before we were in the business.
Yeah.
Yeah.
Are we that young? I thought
we are that young.
Yeah.
I got in 2016.
2016, yeah.
Yep.
So a little bit before our time.
That's right.
So it's been obviously challenging for buyers. They've been balking at the higher interest rates, waiting for the market to collapse, hoping that prices come down. And we've kind of covered this in a few other episodes, but I think ultimately we just believe that the interest rates or the prices of homes are not going to come down in any real material way. So from your guys' perspective on the lending side, what are some of the strategies? What have you been kind of doing to help your clients get off the fence and get into the world of buying here?
Yeah, a lot of the dialogue with clients, specifically the last 6 months, is it the right time to buy?
Yeah.
And obviously that's a loaded question because nobody really knows.
Sure.
But trying to operate with where's the client at financially now? Where do they want to be 3-5 years from now? Income projectability, all those different things that kind of we deal with on our end of looking at what can you afford on the financing side. And given the market that we are in currently, because it was you and I have talked about it, the market was just like a bullet train. You could just not get on. You couldn't get on.
Yeah.
And it's now slowed down to a pace where it's, buyers, there's not as many buyers in the market. So buyers do have the opportunity to actually acquire a house.
Yeah.
Now, interest rates are higher, so
Sure.
you have to deal with that. But because they do have a little bit more bargaining power, I guess I would say, there are some different loan products that help ease buyers maybe year 1, possibly year 2. Some they're called temporary buy downs.
Yep.
Pretty popular right now, and it's essentially where the seller pays for a portion or kind of prepays a portion of the buyer's payment, either for the first 2 years, and possibly even the first 3 years. So that gets negotiated with the purchase and sale contract and with their agent when they're making their offer. So ideally, it kind of bridges the gap between now when we have these higher interest rates and kind of the outlook of, okay, interest rates at some point are going to be coming down, whether that's a year from now, 2 years from now, and makes that first 12, 24, 36 month period of homeownership a little bit more palatable. So that's been a really useful strategy in the current market.
So before we kind of go on, can you provide maybe a real, like maybe just put some numbers on that, a real world example? What does that mean? What's a temporary buy down? Like, can you help walk through
Absolutely. So currently just kind of rates around 7%. So if you were going to go get a mortgage today, it'd be somewhere around 7%.
Yep.
A 30-year fixed mortgage.
Yep.
And if you were to utilize a 2-1 buy down, what that means is for the first 12 months of your loan or your rate is 2% lower. So for the first year, it's at 5%. And then for year 2 or months 13 through 24, it's 6%. So 1% lower than that 7%. And then for years 3 through 30, the lifetime of the loan, it just goes back to 7%. And you're fixed there for however long you have the loan.
Okay, so it's a 2-year kind of, that's where the temporary comes into play. It's a 2-year temporary fix where you get the opportunity to basically hack off 2% of whatever the market rate is that you took out on that first year.
Yep.
And then in year 2, or as you described it, months 13 through 24, it reverts to 1% off that original market rate. And then it goes to the whatever you took out the mortgage at it.
Correct. And with a loan size of, call it 700,000, which is pretty typical kind of in the market we're in. That's about, for year 1, that's about an $800 savings.
Wow.
Off the payment, per month, and year 2, $400 savings. So, it can be pretty helpful for clients that are, again, trying to get into the market, but it's kind of tough to swallow where the monthly payment's at. Now, you do have to understand, if you do not get out of that loan in the first 2 years and you're still in it, it goes back to, that market rate and being comfortable with that.
So somebody might do that because they're making a bet, an educated or uneducated, but a bet that the interest rates are going to come down. So maybe I'll just put you in that seat really quickly of, being that prognosticator. Do we expect in, call it the next 24 months, that interest rates might be, in that window of that 2-1 buy down, somewhere between 200 to 100 basis points off
100% foregone conclusion.
No doubt. You heard it here.
Wish I could say that. Yeah. When you look at the market, there's futures markets on where investors and people think rates are going to go. And right now, the futures markets are pricing in roughly 4 to 6 rate cuts from the Fed next year. Now, that's could certainly change. That would lower rates roughly 1% ish in that timeline. When you look back at the U.S. economy, whenever the economy hits a recession, rates then come down. So it's a question of, okay, are we heading into a recession economically? Most, I think, economists would agree, at least we're going to get there at some point, if we're not already there. So I do believe at some point certainly the next 3 years, we're going to see rates lower. Now, could we see rates go up and then down? Sure, absolutely. Okay. So it's not just going to be, a straight escalator down.
Yeah.
But I do think at some point there's going to be some relief on interest rates here in the next 3 years.
So real quickly, because it's a little bit dry and I don't want to spend too much time on it, but you and I have talked a lot about how the Fed will come out and they'll talk about how they're going to do rate cuts. But you and I know that that's not necessarily a direct, correlation to mortgage rates being lower, right?
Yep.
So just briefly explain, if you can, the correlation between the Fed cutting their interest rates and then mortgage rates potentially coming down.
The easiest, so the Fed funds rate is what the Fed is referring to, is the overnight rate at which lending institutions lend money to each other. So it's overnight. It's the shortest of the shortest interest rate, whereas mortgages are on the long end of the curve, 30 years or 15 years in some cases. So it's not like a 1-for-1 relationship, but mortgage investors are essentially trying to predict what the Fed is going to do. Because if you lent me $1 today in interest rate, but I'm just giving it back to you tomorrow, it doesn't really matter a whole lot what that rate is. It's one day.
Yep.
If you were going to lend me money for 30 years, you'd really like to know, well, what's my return on that 30 years? Because I'm giving up a lot. So when the Fed cuts their rates, it's not like, oh, that affects mortgages instantaneously. Oftentimes, the mortgage market is pricing in what they think the Fed is going to do. Yeah. So we'll see the mortgage market move prior to a Fed meeting, which, the Fed meetings, they're going to be, there's going to be one in the beginning. There's going to be one this week, and we typically one every couple months. So it's going to be, we'll see market moves up to that meeting. And then if the Fed doesn't do what they say they're going to do, then we'll really see mortgage markets react because the investors were wrong. Right. In that instance.
Okay. That was a little more granular, and we can move on from that lack of excitement, but wanted to at least just touch on that really quickly. Okay. Should buyers wait? Should they jump in? What's the cost of waiting?
Sure.
Maybe tackle a couple of those.
Yeah. My answer to that question is always highly specific. Typically the greatest wealth creator for any individual is owning real estate.
Yep.
Unless you're a professional athlete, own a business, really good at sales, all those kind of, independently wealthy type stuff. Most folks create wealth through real estate, which that's kind of, I think, where we've achieved most of our wealth creation in our short careers is by owning homes. Mm-hmm. So, and then obviously people have to live somewhere. So you look at it and go, okay, well, I'm either going to be paying a mortgage or I'm going to be paying rent. Unfortunately, right now, it's not so easy as, well, rental payments and mortgage payments are the same, I might as well own. Yep. No, mortgage payments are, in our area specifically, are going to be higher than rent payments,
and pretty dramatically right now.
Yeah, pretty dramatically. So not going to sugarcoat it and say, it makes, the numbers all line up for you to be a homeowner and for it to make sense just purely by the numbers. But when you look at it on kind of a 5-10 year run, right, and going, okay, can you try to time the market? Sure, you can try. I think most people that have said they've tried or timed the market well has just been purely lucky in terms of like, oh, I caught this dip. We do expect with interest rates coming down, whenever that happens, that's going to bring more buyers into the market, which, simple economics would tell you more buyers means prices at a minimum don't go down. Right. So, there's a lot of that back and forth of, well, I'm going to wait for prices to come down, which fair enough. You can have that sentiment. I think there's a chance prices can come down. There's equally as good of a chance, I would argue a little bit more, that prices will go up. So where is that going to leave you 6 months from now after you've paid, 6 more months in rent, which is just lost money, or a year's month in rent, which is just lost money. So is it the right time to buy? If you think you have a stable job, if you think you're going to be in that area, at least 3+ years, your job's not going to move you type thing. Mm-hmm. I don't think it makes sense to rent. Yeah. Just purely waiting for the market to get better. Because even with lower rates, you're going to be dealing with higher prices most likely, and you're kind of going to be in that same situation, and you will have lost out on that appreciation if you wait for rates to come down and prices to go up.
Yep. Yeah, I read the other day a stat saying that owners an owner's net worth is 40x that of a renter's net worth. Then obviously that's over the course of 30+ years or whatever the life of a mortgage might be. But that's pretty substantial.
Yeah. You can find charts everywhere. Real estate, it doesn't only go up, but on the long term, right, like the trend is up. And of course you can catch bad cycles where if you bought in 2006 and sold in 2009, it's like, you're in a bad type of way. But, we have clients that bought beginning of 2022, which was kind of like the height of the COVID run. Mm-hmm. And if they went to sell their house now, they wouldn't get what they bought it for. Yep. But
it's a great point.
Do they need to sell their house now? No. Yep. Great. How's that 2.75 interest rate treating you? Hey, I can still afford the payment. I still have my job. Keep making the payment, because I think we're going to find ourselves in 5 years going, Well, yeah, the market's continued to go up.
You brought up an interesting point for folks who have had, if they took debt out in 20 or 21 or, even beginning of 22, where their mortgage is a 3 or lower. What would your recommendation be for that individual if they want to, let's say they either want a bigger home or they want to downsize or whatever, they want to go buy something else. How do you attack that conversation with them, knowing that even maybe just as a simple hedge against inflation, it's a good idea to keep that debt?
Yeah, totally. It depends. Do you want to be a landlord? I mean,
sure.
We both have rental properties, so there's pros and cons to being landlords.
No doubt.
It'd be good to understand, could you rent it out for what your house payment is or more? Could you cover your monthly obligation? And going, okay, again, most, appreciation typically is the play here, single family, right?
Yep.
You're not seeing a ton of monthly cash flow, but can you at least cover your monthly payment with the rent, and then looking at different loan products for utilizing your equity to go buy something else,
right?
And going, okay, can you look at getting a line of credit to pull money out? Can we look at doing a bridge loan type thing, which are different loan products to utilize existing equity to buy your next house?
Yep.
So I think if you can hold on to it because it's a great, again, real estate is a great investment. A lot of the situations or clients that we have that are looking to buy don't necessarily want to be landlords.
Sure.
They just, their family's growing or their family's decreasing. And so there just doesn't make sense for their current house doesn't work.
Yep.
And getting into the next, unfortunately it's again, the numbers are different. They just are. And going, okay, does this fit your lifestyle? Does this work for your family? Because if it doesn't, then we just got to talk about, okay, what's the next step? Because we're not in 2020 anymore. We're not in 2022 anymore, where we're getting, really inexpensive debt.
Yep.
So,
yep. I feel like we could keep going. We could just rip through topic after topic here, and I had more to cover, but I don't want to take any more of your time. I know your time is valuable. If you would like the opportunity to meet with or have a conversation with Pierce, you're jumping into the market and you want to try to understand your financial position and what you can afford, feel free to reach out to him. We'll link his, I don't know, are you on social media?
Yeah, I've got an Instagram.
Can we just put your email in there?
Yeah, we'll do email and cell phone's easiest way to get a hold of me. Text, text obviously.
Yeah, we'll put contact information in the show. But Pierce is my preferred lender. Again, obviously a good buddy of mine, somebody who I trust. So if you need a sounding board, someone just to shoot you straight, not sell you anything, he's a great resource for that. So highly, highly recommend reaching out if you have any questions. Pierce, thanks for taking the time. Thanks for coming on. And we're
always
grateful that you enlightened us here today.
Love talking shop with you.